I think everybody is more or less in the call. Hi, everyone, and welcome to the Sustainable Finance Research Seminar this week. It's a pleasure to have Aleksandra today here with us from York University, and she will present the salience of ESG ratings for stock pricing, evidence from potentially confused investors. And usually the usual rules apply. Please mute yourself unless you have a clarifying question in between. Otherwise, if it's a longer question, there's a Q&A in the end, and we will record the session. And yeah, without further introduction, I would like to hand over to Aleksandra. Thank you very much for being here, and we're looking forward to your presentation. The floor is yours.
Thank you so much. I really appreciate that you gave me the chance to present the paper, and I'm very much looking forward to your feedback. So this is the paper co-authored with Kathleen Hanley and Loriana Pellisson. And this is a very already ESG paper when it comes to gender, is a very female-oriented group here. So generally, probably all of you already know this, but social responsible investment is an extremely important nowadays. There's a lot of assets being invested in SRI, and people pay more and more attention to sustainable issues. And while the increase in assets flowing to SRI investment, the role of the sustainable ratings also becomes more important. The role of the sustainability ratings are generally important, for people to access the information about the sustainability, environmental, social, and governance activities of the firms. And the importance of this information was already recognized by, among others, SSC or European Union that are already considering or implementing the regulation regarding ESG disclosure. And that's why there is a huge reliance on those ESG ratings and reliance on their rating agencies to provide investors with important information. And we already know that rating agencies are important, and they play a significant role by looking at the credit ratings in the history. Now we are facing new type of ratings. Those are the sustainability ratings. The role of sustainability ratings is essentially the same as the role of credit ratings. So rating agencies are supposed to gather information, digest this information, and produce a very easy readable score for investors to take it into account and invest accordingly. And you probably also know, especially based on Julian's research, that those rating agencies oftentimes produce very incompatible ratings, that there is a small overlap in what the ratings say, and this also can create an investor confusion. So we kind of are a little bit worried that just relying on those ESG ratings without doing your own investors' due diligence may contribute to the confusion or may result in misinterpretation of those ratings, and thus is going to result in a suboptimal capital allocation in the market. Generally, it is hard to disentangle the effect of their ESG ratings on the company or the capital flow, because we are facing an homogeneity issue. Always, when there's a change in the ESG rating, and this change in the ESG rating is followed by the price pressure or the change in the return, we don't really know whether the return effect is due to the change in the ESG rating, or is it rather because of the fundamental information that happen in the same time that affects the future cash flow. So it's hard to disentangle those two things, and just looking directly change in the ESG rating, what is the effect of the returns, there might be this omitted variable that what we are really capturing. So what we try to do here, we try to address this endogeneity issue, and we are going to explore a quasi-natural experiment, a modification of Sustainalytics ESG rating methodology. What happened was in October 2019, and Morningstar and Yahoo Finance introduced Sustainalytics' new ESG rating. And the new ESG rating was different from the previous ESG rating because of two reasons. The first one was that the scale got flipped. So before, the high rating was associated with being very ESG friendly, and the low ESG rating was associated with being unfriendly to sustainability. Now the scale flipped. So the lower the number, the more ESG friendly you are. The higher the number, the less ESG friendly you are. And there was a second also change to the rating, that before you could only compare companies within an industry, and now you could compare the companies across industries. So before you could only look, let's say, in fossil fuels and see that ExxonMobil is better than Shell. Now you can compare Shell to Microsoft, because their scale are going to take into account industry-specific ESG risk. So by using this change in the methodology, we first want to see if people pay attention to the rating themselves, and whether the information that is included in the ESG rating, whether this is going to affect the price of the stocks and is going to put a price pressure on the affected stocks. So let me just shortly talk about the ESG rating methodology change again. So before, we were talking about the ESG rating, and the scale of the ESG rating was before 0 and 100. And whenever you were had a very low rating, it meant that you were ESG unfriendly. Whenever you had a high rating, it meant that you were ESG friendly. Now, after the modification of the rating, we're talking about ESG risk rating, which means that we don't want to have a lot of ESG risk. So whenever you have a high ESG risk rating, it means that you are ESG unfriendly. And if you have a low ESG risk, it means that you are very friendly in terms of ESG-ness. So this is just an example how different companies, I just chose 10 different companies, how different companies were affected by this ESG risk rating. So Microsoft was and is generally one of the companies that are the most ESG friendly. So you can see that before the modification of the rating, Microsoft had a very high rating, 75. And after the new methodology adoption, it had very low ESG risk rating. So in our terms, there is going to be the pseudo ESG downgrade of Microsoft, because investors, one day they will see on Yahoo Finance rating of 75, next day on Yahoo Finance, they see 14. There's another example, Ariston Energy, right? Its ESG rating increased from 46, so it was relatively low before the regulation, but now the ESG risk rating is even high. So Ariston Energy is going to be an example of a company who's going to be pseudo upgraded. And you can see that some companies, even though they had the same rating before, their ESG rating after was very different. And this is probably because they belong to different industries. And later on, we're also going to control for the industry part in the rating. So this is just an example. This is just how the change in the ESG rating looked from so the ESG risk rating after minus the ESG rating before. And you can see that, right, there's nothing funky going on with the distribution. And there's only 6% of the stocks that got pseudo upgraded. So this is the orange line, and to the right there's the 6%. Here, the second orange line to the left, that marks a lower quartile. So we are going to define also a pseudo downgraded stocks as all the stocks whose rating was lower than minus 28.27. So our research question is whether ESG ratings are important for investors, and if they are, whether the change in the ESG rating can affect the prices itself without any information about cash flow, future cash flow, or firm fundamentals. And if the ESG ratings are important, who plays the main role in shifting, rebalancing their portfolio in order to respond to the changes in the ESG rating. And we're going to look at institutional investors, mutual fund, individual investors, and short sellers. The literature that we are contributing to is pretty large, and I'm just going to very shortly talk how we find our contribution to the literature. So first of all, right, the discussion is how investors value the SRI aspects. And we do argue that we show that investors care about SRI, and their rebalancing can affect the house prices, the stock prices. Then there is also more theoretical literature that implements ESG characteristics into asset pricing models, and our results are consistent with the model prediction of Pastor et al. And Pedersen. And the last part is that we think that we contribute to the literature is about the role of information intermediaries, but also the role of ESG rating itself and all the confusion around them. So let me talk shortly about the ESG rating methodology change, the timeline. So in March 2016 was the month where Sustainalytics, one of the lead provider of sustainability ratings, launched its sustainability ratings. In February 2018, Yahoo Finance makes Sustainalytics ESG rating available for free on their website. So around 3,000 stocks, a little bit less than 3,000 stocks were available on Yahoo Finance website for free. In 2018, Sustainalytics was in the meantime working on the new ESG risk rating. And in 2018, September, Sustainalytics introduced its new ESG risk rating. And nothing happened for a year until October 2019, where Yahoo Finance and Morningstar adopted the Sustainalytics ESG risk rating. So we are going to focus on this orange part on the October 2019, because this is where most of the investors had access now to the change in the ESG rating. So now all the retail investors, if they log into Yahoo Finance, they can see from one day to the other that the ratings change a lot. While maybe other investors that already were subscribing to Sustainalytics platform, they probably have the information about the ESG risk rating before. So our data comes from a pretty, to some extent, it's pretty standard data. So this, all the prices and returns come from CRIS, and we concentrate on New York Stock Exchange, NASDAQ, and Amex stocks. The ESG rating from Sustainalytics we take from Morningstar, and it's really funny if you look at the Morningstar Direct, how from one month to the other, for example, for Morningstar, the number just completely changed from 75 to 14.58. So the ESG risk in brackets rating come from Morningstar, and then we look at a lot of different types of investors. So we use the stock popularity measure from Robinhood, 13F institutional ownership from Thomson Reuters, mutual funds holdings from Morningstar, and monthly short interest also from Compustat. So this is our summary statistics, and this just shows that there's nothing really funky going on in our results. Again, you can see that the mean ESG rating before is higher than the mean ESG risk rating after, and this comes mainly because of the change in the methodology. So I'll start my first analysis by looking at the effect of the returns. The effect of the change in ESG rating on returns. So I'm just using a very standard generalized diff and diff regression, where I have on the left-hand side, I have the abnormal return, and on the right-hand side, I have my exposure to the treatment, which is the change in the ESG rating due to the new methodology, interacted with the post-dummy variable. I control for stock fixed effect, and I also control for industry times time fixed effect. And the reason is why we think it's pretty important to control for industry times time fixed effect is because, right, this regulation allowed comparison across industries. So we want to make sure that we are not capturing anything that is industry driven and not new methodology driven. And our results are, so those are the most conservative results that we have. If we control only for time fixed effect, the coefficients are of similar magnitude, but they are more significant. So
maybe a brief question.
Sure.
Sorry, this is Flor. So for the post and pre-period, what's the time period you're looking at? So short term or long term?
So we only look at the short term, and the reason is I will show you in a couple slides that this is only transitory effect. So we only look at 3 months before and 3 months after, because we see that I can just jump a slide. Just let me jump a little bit. So this is what I was supposed to talk a little bit later, but you can see here, right? This is our reference month. This is the first month when the rating was introduced, and here you can see that the effect disappears in February 2020. We don't want to make too much of the statement because this is where the COVID crisis started, but it's a pretty short period, right? It's only transitory effect, and we argue that investors, in the end, you know, they learned that there was only a pseudo change, not a real change. Okay, so I'll just go slightly back to, oops, I went now too much. So I have 3 or almost 4 measures of the treatment. One is the change in the ESG rating in the first month after the adoption minus the last month before the adoption. Here I have a change in average ESG rating, and in order to capture directional effect, so I also have 2 dummy variables, a pseudo downgrade. This is for the quarter of the companies with the largest negative change in their ESG rating. And then I have pseudo upgrade, which is a dummy variable equal to 1 for the 6% of the stocks that experience a pseudo upgrade in their ESG rating. So you can see that regardless whether we use single factor, 3-factor, or 4-factor abnormal return, our coefficient on the interaction term is positive and statistically significant, meaning that the stocks, you can read it in both ways, but the stocks whose ESG rating decreased the most, also their abnormal returns decrease the most. And you can see also right here, when we're looking at the dummy variables, those results are very easily interpretable. So this is around 1.7 percentage point. The abnormal return decreases for stocks who experience the largest ESG pseudo downgrade. The coefficient on the pseudo upgrade, it's not statistically significant here, again, because we have a very conservative specification where we control for industry times time fixed effect. When we relax our specification, and we have this in the appendix, where we only control for time fixed effects and for stock fixed effects, of course, and this coefficient becomes statistically significant. And we also cluster our standard errors at the stock level. So this is, for me, the result in a nutshell. What you can see here is that on the x-axis is the change in ESG rating relative to the mean change. And on the y-axis, I have the change in the abnormal return. And you can see that those stocks that had a very high positive change in the ESG rating, their abnormal returns increased. On the other hand, stocks that had a very low change in ESG rating, their abnormal returns decreased. And we are going to try to argue that this is really not information driven. This is only due to the change in the scale. Here, we start concentrating only, we're trying to isolating or convincing you as a potential reader that we only are capturing the change in the scale and not information. We do so in many ways. Here on this slide, we control for change in the Sustainalytics rating. We observe the Sustainalytics ratings before the new methodology adoption by Yahoo Finance and Morningstar and after. So you could think that, for example, in the meantime, during the adoption by Yahoo and Finance, there was an oil spill. So we want to control for the fact, right, that there was an oil spill, and that change in the Sustainalytics rating should capture if there was a new oil spill or air pollution done by a given company. And here we also control for the relative rank. So, right, companies change their relative rank. And again, before you could only compare companies within industry. Now you can compare companies across industries. So now, given the rating, the rank of company might have changed. So we also control for that. That would potentially suggest that this goes direction of the information. So you can see that the ESG rank only is significant for the abnormal returns, for the single factor abnormal returns. Otherwise, none of those control is significant, and our coefficients of interest stay both in the magnitude and also in terms of significance the same. So this is what I already talked. This is just dynamic diff and diff to show you how the dynamics of our analysis look like. And now we enter the question how the mutual funds are going to, not mutual funds, generally investors are going to respond to the change in the rating. So who drives this price pressure? So we start looking at retail investors, 13F institution, and short sellers. And we have here, again, this is a different specification already done in first differences, where on the left-hand side, we have a change in the ownership, and on the right-hand side, we have a change in the ESG rating. So in contrast, what we had before, we had a panel where we have 3 months of returns before and 3 months of returns after. Here, we'll look at the change in ownership in the last month, in the September, and before the adoption, and last month, and the first month after adoption, which was December. And we look again at the retail investor, 13F institutions, and short sellers. And what you can see here, that retail investors, first of all, this is participation, this is not ownership, which means that we only will see a change in the retail ownership, so to say, if there is an investor that either entered a position in a stock that previously he or she didn't hold, or completely sold his or her position. So we'll only change if somebody entered or completely sold his position. And you can see that retail investors, probably not shockingly, they are the ones that are getting confused by the change in the ESG rating. So they're the one that increase, they participate more when the stock gets pseudo upgraded, and they decrease their participation when the stock gets pseudo downgraded. At 13F institution, we look literally in terms of shares, right? So we can see that it's 13F institutions are probably better informed. They might have already had an access to they might have had already access to sustainability ratings before. So the change in their ESG rating through Morningstar or Yahoo Finance, it's not news for them, and they seem to not respond to the rating at all. And now we look at the short sellers, which are the clever guys that, according to the literature, are able to process information more efficiently and are supposed to arbitrage away the mispricing. And this is exactly what they try to do. So they are taking advantage of the confusion of the retail investors. So they increase the short interest for the stocks whose ESG rating increased, and decreased their short interest for the stocks whose ESG rating pseudo decreased. So they are taking advantage of the actions of retail investors. And we then really zoom into different types of mutual funds. We zoom at ESG funds, and we define ESG funds based on their names, whether they claim already in their name that they are ESG focused. We look at the GGL funds that comes from Janetti, Ganchev, and Lee paper. Those are the funds that try to strategically change their portfolio in order to get upgraded to another, to a better classification, the ESG globes, and all other funds. Those are the funds that are neither GGL funds nor ESG funds. So those are the funds that we don't think that they are so focused on ESG. So you can see that ESG funds seem not to be tricked by the change in the methodology. Here we are getting a positive coefficient, but yeah, we don't really have interpretation about that. Might be the case they are still not fully understanding what's going on. GGL funds, those are the funds that are trying to rebalance their portfolio towards better ESG stocks in order to be classified to a higher globe. Those funds, they are not tricked by the new methodology. And when we're looking at the other funds, those are the funds that are not primarily focused on ESG. They seem to behave exactly as retail investors. So they increase their position in the stocks that got pseudo upgraded and decrease their position in the stocks that got pseudo downgraded. So here I'm just going to try to convince you that we are trying really our best to control for the fact that this is what we're capturing. It's not information. So this comes already kind of this. We're trying to make sure that our results are robust. And what I'm trying to show you here is that apart from the ESG risk rating, there is also a classification of the companies, very similar to the ESG globes that Harsmark and Sussman use in their paper, and they are also available for the firms. So during the ESG classification, they also slightly change the names of the classification for the stocks. And you can see that really what happened is that there was not many stocks got shifted many classifications away. Most of the stocks stayed on diagonal, so they were in the same classification before and after. Some stock moved up and down one notch, very few moved more than 2 notches. So here what we're trying to do, we're now saying, okay, we're going to control for the information part that there was an oil spill, but we also want to control for the fact that whether right you are in the same classification, because the classification could potentially be also information, or at least right could be due to the change in the interpretation within an industry and across an industry. And you can see again, right, those coefficients stay insignificant. Our coefficients of interest don't change and stay significant across the specifications. And we also, I have a little bit of time, so I also want to show you one result, which is this unambiguous set. We also concentrate on the subset of stocks where we argue that the change in the ESG rating should be unambiguous. So those are the stocks where they have either no change or their ranking, the relative ranking increase. So now they're supposed to be better ranked than before. And you can see that, right, if people or investors really understand what's going on, they will not respond, because those companies they only became better over this period than worse. And you can see that our results stay the same even when we look only at the subset of the stocks. So now there are two of my very, very, very favorite results, I have to confess. And we are exploring heterogeneity. And we are trying to show that really the channel that we are exploring comes, as we are saying, from the confusion of unsophisticated investors. So the first analysis here, we come up with a triple interaction, the exposure to the treatment, the post, and then we also look at whether a company is held by a high fraction of institutional investors, and at the same time, it's not held much by the retail investors. And we are looking at the effect of this triple interaction on the abnormal returns. And you can see that now the stocks that are predominantly held by institutional investors, those are the investors that are not being tricked by the new methodology, they react less strongly to the regulation. So they react, right, if we add up those two coefficients, the effect of the ESG rating itself, it's way smaller than for the companies where they are predominantly held by the retail investors. Here you could also argue, right, that our analysis is not really full, because we are only looking at the one ratings provider, Sustainalytics, and theoretically investors might have access to other ESG rating provider. And we look especially at the MSCI ESG ratings, for the reason is that MSCI ratings are also available online for free for a subset of companies. So if you are a poor investor and don't have any fancy subscription, you can check both Yahoo Finance, and you can double check whether really something happened to a company by looking at the MSCI. So if you want to make sure that not to be confused, you can do the double check. The only thing is that MSCI website only provide ESG rating for, I would say for US around for 500 companies, because this is like the world index that they provide the ESG rating for. So now here what we have, we interact a dummy variable whether a stock is, so to say, double listed, both or the ESG rating for a stock is available both at the Yahoo Finance and MSCI website. And again, you can see that if investors have access to the information, they will double check. So now the triple interaction coefficient is again negative and very sizable. Those two coefficients almost cancel out. So now those companies that are both on MSCI and Yahoo Finance, they almost don't experience any price pressure coming from the methodology. Only stocks that are available on the Yahoo Finance, they will be, their abnormal returns are going to be affected by the new ESG risk rating. We do a lot of different robustness checks. So we make sure that those results are not industry driven. So on purpose, we exclude fossil fuels, oil and gas industries, companies that belong to those industries. We take them out, our results stay beautiful. We also add the level of the MSCI ESG rating into the regression, and also by controlling for the, we also include the change in the MSCI rating into the regression. And if the company is not available at the MSCI website, we just give a change of 0, and that does not affect our results. It was pointed to us that at the same time, there was a reconstitution of Dow Jones Sustainability Index as our experiment takes place. So we look at the constituents of the Dow Jones Sustainability Index, and we control for companies that were part of the index, companies that were kicked out of the index, and companies that were included into the index. And again, our results don't change. We also want to make sure that our results are somehow not correlated to this GGL trading pressure that comes from Giannetti et al. Paper. We have also a less conservative specification where we control for only time and stock fixed effects. We also cluster our standard errors in other specification at the industry times time level. The only reason why we don't cluster our standard errors at the time level is because we only have 6 time periods and there's too few clusters to cluster. So now we are trying to also do wild bootstrap to cluster our to have to do the wild bootstrap with very few clusters, as few as 6. So we argue that our results are the following. We argue that ESG ratings are important and they might shift capital allocation in the market. Short sellers, they are trying to take advantage, or they are trying to arbitrage away the confusion of the investors, and they increase their short interest in the stock that got pseudo upgraded and decrease their position in the stocks that got pseudo downgraded. Retail investors, right? They do care about the ESG ratings, but sometimes they lack the due diligence to really understand what the rating means, and they are going to become the confused investors. So overall, we think that it is important to pay attention to the ESG ratings, but it's important to understand the ESG ratings. Another thing is that probably some framework, what the ESG ratings should include, and having a framework or regulation that is supposed to facilitate investor understanding what it is behind the ESG rating, that will be also very helpful so that there's no more confusion around investors. So that was what I have had prepared for today. And yes, thank you so much for giving me a chance to present the paper.
Thank you, Aleksandra. Thank you for your presentation. Really interesting. And yeah, I would like to open up then the floor for questions from the audience. Let's start the Q&A. Okay, if there are no questions, so I will start.
I can go ahead.
Okay,
hi,
then.
Aleksandra, Julian here. Super cool paper. And it was nice how you exploit that opportunity there. I was wondering about the volumes. Basically, I think you're saying that the retail investors are confused, while institutionals and professionals, institutionals don't move, and professionals kind of exploit the confusion. That's is that pool of private investors who look at ESG ratings online big enough? I was just wondering, something about the size there.
So, okay, so I think what really helps us, so this is a very fair point. So I think what really helps us also is that this is not only the retail investors, this is also other mutual funds. And I think that a little bit helps us, right? Because we know from the prior literature that, mutual funds can indeed exert price pressure. And so if we assume, right, so if we assume that retail institutional investors don't really trade, right, their portfolios long-term, and they rarely rebalance their portfolios, and at the same time, retail investors and mutual funds put their forces together and trade in the same direction, I think that that is enough to exert price pressure. And again, we know from the literature, right, even fire sale literature, that when mutual funds have fire sale and they have to sell the stocks, even though we know that there is nothing wrong with those stocks, they only sell it because they need liquidity. Short sellers, they don't have enough power to absorb it, right? They are not now going to, they are not able to arbitrage this away. So I think what I'm trying to say is that I think, it would be great to have a more granular data on retail investors, but I think having those two forces, retail investors and mutual funds together, that makes feasible that the price pressure is there.
Thank you. Yeah, that's convincing. That's right.
It would be also interesting to know if the retail investors would have access to several providers. So if they would have actually several of these scores, they would be less confused, because I think that's what you kind of try to show, right, by including this MSCI, but you do not have this granular data, right?
So with the MSCI, right, so I don't have personally, I don't have MSCI data, but then on the other hand, I'm like a regular investor and not being super sophisticated. So, if I'm confused with, I don't know, Tesla, that the Tesla's rating change, I can go, right, I will go to Yahoo Finance and then I can double check if maybe Tesla is also an MSCI. So downloading data from MSCI was pretty painful, and it kind of either you had to do it by hand or you have to scrape it. But yeah, there's only a small subset of the company. So if you are aware of any other data set that, for example, you can access the ratings for free, right? Because this is what the retail investors will do. They will probably access the ratings for free. They would be great, because there would be another way also to make sure that, we are controlling for the fact that investors could have checked what the rating is. I just, a kind of a story so the reason how we started working on the paper was I was buying data from Morningstar. And I look at the Morningstar Direct, and I was confused, like what's going on between September and October. Like literally, as I said, there was a change in September you can see 75, and October you can see 15. And I contacted people from Morningstar, and they were also telling me, oh yeah, there was the change, there was new methodology. We got a lot of emails from our customers, what's going on. So to some extent, like it also makes me a little bit like I have to believe in my own paper for sure, but it also makes me believe more that not only retail investors, but also professionals that subscribe to Morningstar as their data provider, right? They also were a little bit surprised and puzzled by the change that Morningstar just, put into their system. Morningstar was fair because they also sent a lot of information, but personally, when I get an email from Morningstar, in most cases, I don't read it. So maybe many professionals had the same issue, that they were theoretically informed, but practically they never read the Morningstar email.
Okay. So any other questions from the audience?
Yes, hi, this is Florian. Thanks a lot for that presentation. So maybe on the short sell, I also find that really interesting. Do you think there was kind of a sufficient amount of short sellers that saw this change coming, or knew what, because for me, it's not obvious ex ante how the market will react. It's kind of, so I'm still a bit puzzled what the short sellers would do if
So short sellers, so had I been rich, and then I would have bought probably access to I think it's now FactSet, where they have granular information on the assets when it comes to the short selling. And, you know, there you can see, right, all the information, what is available, how much is on loan. And you can see also the fees that short sellers are being charged. So had I had this access, right, there would be a nice exercise to see, right, it is really, did they push the utilization to the limit, right? Did they use all the lendable that was there? Or, you know, they just, or maybe they just didn't react to, I don't have a strong prior, but to some extent, I would guess that if you can proxy for the availability of the short selling through institutional holdings, right? Because institutions are the one that that lend the securities to the short sellers. So that would go a little bit, I would say, this direction regression. That the limiting factor here was for the short sellers was that they did not have enough lendable. And right, so this is if they had a lot of lendable, so we can interpret this regression also in a little bit other way. So if now, right, the high institution means that there is a lot of shares available for lending for the short sellers, the effect is smaller. So my interpretation would be that probably there was not sufficient lendable, and that's why the short sellers, they didn't have enough opportunity to short sell. That would be my story.
Yeah, thanks. Interesting.
Maybe on the implications, I was wondering, you know, could someone sue either of these institutions for kind of market manipulation? So do you think the effects are, you know, of an extent that is thinkable?
So, okay, I don't know. So one of the reasons, like you can't sue Morningstar. Like I got also like a whole leaflet from them, and you know they started their campaign informing, I would say 4 or 5 months ahead. The only thing that I would say is shocking for me, because the shocking part for me was the Yahoo Finance. So first of all, I spent a lot of time contacting random email addresses from Yahoo people, because it's very hard to contact Yahoo people generally. So and shockingly, I did not get much of a response. And then our research assistant, Carmelo, he is super clever. So what he did, he used the time machine like a browser. So he went back in the time for the Yahoo Finance, and you can literally see on the time machine how from one day, I think, until like the last trading day in September, and then first trading day in October for Morningstar, and how those two numbers, they're just completely different. So I don't know if you can sue Yahoo Finance for providing free data. I think this is a part of taking the risk, right? Being, if you want something for free, then you have to take the risk that it's not going to be full information. And we really also spent an extreme amount of time trying to figure it out whether Yahoo Finance announced anywhere that the rating changed. Nowhere, and we were unable to find. So I think if you want to pick up the fight, I think I would fight against Yahoo. But on the other hand, it's nice that they provide free data. So
yeah, I was maybe jumping the gun with bringing a case, but you know, I mean, partly the question was about economic significance. So you know, would there be value in something like that? And you know, you could also think about regulation noticing, well, you know, this, you know, you could argue this is something you want to protect investors from happening again. Right?
So
someone
for
lost
sure.
money.
So that's for sure. So
Yeah.
the impact was large, right? So those are not peanuts. This is like 80 basis points here, right? So this is not a small effect. So if that was in any way somehow done strategically, right, that was a great way to take advantage of confusion of people. I think the bigger issue is here that, like, as it is in your paper, right? People really, like in your paper, you have those ESG ratings, they don't overlap at all. And people rely on them, but they, like, you do a great work going through the details, what's inside and so on, but like people don't know what's inside and they just take it at its face value. You know, AAA, amazing, let's invest in that stock without realizing what is inside. So what I think a bigger picture is here, that there should be somehow a very transparent framework how we define the ESG rating and what are the inputs and how they work, and so that people, if they want, right, many of them are going to be lazy and they won't read the fine print, but if they want, they can understand how they are created and what they mean.
Yeah, there I definitely agree.
Maybe one more question on effect sizes. Here, the dummy variable on pseudo downgrades, you have minus 1.5. So that's minus 1.5 over 3 months. Huh?
Yeah, so this is an average return over 3 months, exactly.
Yeah, so that's not nothing, huh?
It's not nothing, and you know, we looked at the bid-ask spread, you know, just to make sure that this is not wiped out by the bid-ask spread, but no, like the bid-ask spread is like a tiny percent of that. We also, you know, for ourselves, we control for also time varying liquidity, whatever. So this is not small, this is a pretty large, and like, even if you, so, and this is what it's pretty well estimated because we have a lot of companies. Let me just jump, because this is this guy, exactly. So you can see if we now have a less conservative regression only with time fixed effect, now the pseudo upgrade, now we're right comparing to the group of the companies that their ESG rating has not changed much. The pseudo upgrade has even larger effect, right? And this is also comes from the figure that we have, the motivating figure with the semi-parametric figure. So what is nice that it affects, so to say, both ends, not only one, and it is sizable. It's short, right? But we don't want to have it long. If there was long, we would probably there would probably not be this change in the methodology. If it would be like, you know, until now the effect stayed, because that would mean either that people don't learn, or they just or there was some other shock that affected those stocks. But it's a short period effect, but it's still a large effect.
Interesting. Maybe one more question on, you mentioned that you also checked how the Yahoo page and how it looked. So I saw Morningstar. I also had a look on older downloads I have for Morningstar. I mean, at least the graphical representation didn't change much, because they just flipped the scale without, I mean, still green is green. Of course, the numbers below the scales, they flipped, but I wouldn't notice like that, obviously. Of course, if you say people get their kind of data stream from there the data stream looks funky, that's a different thing. But did you have any, on Yahoo, did they make it clear visually that?
So for me, what I saw, and I mean, we should probably more or less include it into our slides or paper, it was one day, I think that what they were clear, at least, that it is now ESG risk rating, but it is ESG rating, and there was not really much.
So they don't offer a distributional bar like Morningstar, where you can see where your company is compared to the peers.
Okay, I don't know whether they had this before. Now I think when you go, when you go on Yahoo Finance, now you can see also a little bit of the distribution there. I should double check it, you know, how it looked in the time machine, whether there was any information in the time machine about in which percentile rank you are. I think now they let me Yahoo Finance. That's the perk of having online presentation, because I can double check it. Yahoo Finance, okay, Microsoft, and under sustainability. So okay, I can. I'll just let me just change my screen if I figure it out how to do. I should be stop sharing after 2 years of being. Oops. Now 1 second. This is exactly how I always teach, show my kids on my screen. So this is how it looks now. So you can. So there is a 6th percentile, but doesn't really mean whether it's a good 6 or bad 6.
Yeah, before I guess Microsoft had like 70th percentile or
exactly
74th.
So in our data set, this is the company that has the highest ESG rating before and after. So they are always ranked 1.
Interesting. Yeah, so that I guess that really confuses people if you from one day to the other you just see the opposite number and
I think, like, again, right, and again, if we were just so the high institution dummy variable is also very much correlated with being large market cap. Probably not surprising. So you could also think in the triple interaction that we have, that what maybe is driving this is that there is a large company that you have easier access to the information about this company. So, you know, it's more articles, financial articles about that and so on. So maybe it's also, you know, you can double check, right? You can double check whether this is really something happened to this company or it's just a fluke on Yahoo Finance. While the MSCI, we were very, 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 very happy that the MSCI variable, it's not correlated with the size much. It's, I think, like 20% or 15. So this is what we are capturing with the MSCI dummy. It's very different from from just capturing with the market cap or high institutional.
Interesting.
Maybe a last question, a final question for Aleksandra. We have still a little bit of time. But if there's no question, then thank you very much, Aleksandra, for your presentation and everybody for participating and your questions. We will close now the official part of the seminar. And afterwards, we will chat a little bit without recording, in a more informal part. But before that, I would like to hand over to Aleksandra again for some closing words.
Really, thank you so much for all the questions. And I think, yeah, I will for sure. We are still rewriting for 100 times the paper. So I will try to make sure that what was not clear in today's presentation, that it will be clear in the paper. So thank you so much for all your comments and questions.